If you own a home and are considering selling it, knowing and preparing for what taxes you may owe is critical. There's even a legitimate way to pay less capital gains or even skip them altogether if you follow some simple rules that I'm going to review in today's show. Welcome back, everyone. This is episode 928 of Money Girl. I really appreciate you spending some time with me. I'm Laura Adams, an award-winning author, spokesperson, money speaker, and founder of The Money Stack. That's my Substack newsletter. I've been bringing you personal finance tips and advice weekly on this podcast since 2008 with over 44 million downloads. You can learn more, ask questions, and sign up for The Money Stack at lauradadams.com. And newsletter subscribers automatically receive my Money Success Toolkit with the exact templates I use to manage money. So I hope you'll take advantage of that. Again, I really appreciate you spending time with me. Maybe you're taking a walk or doing things around the house. Where I am down in Florida, it's starting to feel like summer. It is really warm, so I'm trying to do all my outdoor things really early in the morning. But wherever you're listening to the show, thank you. So let's talk about the capital gains tax. You probably know that you have to pay tax when you earn money from a job or from a business or even when you earn interest from a bank account. That type of tax is called ordinary income tax, and it ranges from 10% up to 37% for 2025, and what you pay depends on your income and your tax filing status, such as whether you file taxes as a single person or you file jointly as a married couple. However, you do have to pay a different tax, which is called the capital gains tax, when you sell certain assets for a profit. For example, if you sell a capital asset, and that might include stocks, exchange-traded funds, or real estate, for more than you paid for the asset, you have a taxable capital gain. And the tax rate for capital gains depends on how long you have owned the asset that you sell. It also depends on your income and your tax filing status, and I'll talk more about that in a moment. If you sell a capital asset for a loss, you have a capital loss, and those can offset similar gains for a period of time. However, if you sell a home for less than you paid for it, you cannot claim a capital loss or deduct it from your taxable income. So homes, are a little unique in that regard. So we're going to talk about how the capital gains tax affects your real estate. So the good news is that you can claim a massive tax break, which is called the capital gains tax exclusion, when you make money from a home sale. And I'll talk about the rules and who qualifies for this very, very nice benefit in a moment. But first, let's talk about how a home sale gets taxed. The rules can get a little complicated, but I'll take you through 4 steps that are used to determine your capital gain or your capital loss when you sell a home. So number 1 is to calculate your basis. So your basis is your total investment in your property. Now, this is going to include things like the purchase price, your closing costs, and any capital improvements that increase its value, like, a renovation. Maybe you added a bedroom or a bath or put on a brand new roof. All those things that improve your home, like, new windows, new floor covering. There are a lot of different things that you could do. All of those upgrades to your home increase your basis, which cuts your capital gain when you sell your home. Now, be aware that things like maintenance and repairs, maybe you replace your heating and air filters and, you're spending money on yard work. All of those things are not capital improvements because they're not improving the value of the home. They don't boost your home's basis. However, certain things like allowable depreciation and payments received for home insurance claims, all of those decrease your home's basis. So it's really important to keep good records for any significant home-related transactions, those significant expenses or those significant things like depreciation and income. All of those are going to be important for when you go to sell the home. Okay, after you know your home's basis, the second step is to determine your realized amount. So, this is your home's selling price minus any related expenses like paying a real estate commission and paying closing costs. So, the third step is to calculate your capital gain or loss, and you do that by subtracting your home's basis from your realized amount. And when you do that, you've got either a capital gain or a capital loss. For instance, if your home's basis is $400,000 and you realized $450,000 from its sale, you have a $50,000 capital gain. And the fourth step is to determine your capital gains tax rate. This will depend on your income, your tax filing status, and how long you owned the property. For instance, if you sell a home after owning it for a year or less, you must pay short-term capital gains. And those are actually exactly the same as ordinary tax rates. And I mentioned those range from 10% up to 37% for 2025. Plus, you may owe state capital gains tax depending on where you live. Now, if you owned a home for longer than a year, there are different rates and tax brackets that will apply. For 2025, the long-term capital gains tax rate ranges from 0% to 20%, which is typically going to be more favorable than paying regular income tax rates, which I mentioned are the same for the short-term capital gains taxes. So that's why owning assets like investments in your home for longer than a year is advantageous. Plus, you may owe capital gains at the state level if your state collects it. So now that you know a little bit about how capital gains are calculated when you sell a home, if you have a capital gain, you may qualify to exclude some or all of it from your taxable income. This is the beauty of the capital gains tax exclusion. The rules say that the home must be your primary residence, and you must have owned and lived in the home for at least 2 of the previous 5 years before the sale. Now, the years don't have to be contiguous. If the periods you lived in the home add up to 2 years in those 5 years before the sale, you qualify for the gains exclusion. And the type of home you have doesn't matter. For instance, you could live in a single-family home, a townhome, a condominium, a mobile home, a tiny home, or even a houseboat. While you can own other real estate like a second home or, investment property, those don't qualify for this tax benefit. For the capital gains tax exclusion, only your primary home qualifies. And you can claim the capital gains tax exclusion as often as you like throughout your lifetime, regardless of your age. So in other words, you could buy a home, live in it, and sell it every 2 years throughout your whole life and claim the capital gains exclusion benefit each time. Now, that's not very realistic, but, theoretically, that's something that you could do. So how much can you exclude? If you qualify, you can exclude up to $250,000 or $500,000 if you file a joint tax return. You can exclude those amounts of capital gain from selling your primary home. As I mentioned, you don't qualify for an exclusion if you have capital gains on other real estate, like a second home or a vacation home. As I previously mentioned, if you lose money because your home sells for less than you paid for it, that loss is not tax deductible. Now, previously, the IRS only allowed a home sale capital gains exclusion if you bought a more expensive home within 2 years of selling your old one. Plus, you could only claim an exclusion for up to $125,000 once in your lifetime if you were over age 55. So this tax benefit has definitely gotten better. It's gotten more generous over time. And if you're a widow or widower who does not remarry before selling your home within 2 years after your spouse's death, you generally qualify to exclude up to $500,000 of gains as if your spouse were still alive. All right, so let me give you some examples of how the capital gains tax exclusion works. Let's say you're single and you pay $350,000 for a home and you make some renovations. And let's say those bring your adjusted basis up to $400,000 when you sell the property in 5 years. If you realize $450,000 on the sale, you have a capital gain of $50,000. So that's $450,000 realized less the basis of $400,000. And since you qualify for a $250,000 tax exclusion, you would owe zero taxes on the sale of your home. Another example is you could be married, filing taxes jointly, and pay $350,000 for a home that you live in for 30 years. Let's say you make some significant renovations over the decades and your adjusted basis is $600,000 when you go to sell it. Now, let's say you sell the property and you realize $1.2 million. In that case, you'd have a capital gain of $600,000. That's $1.2 million minus your basis of $600,000. And if you qualify, you can exclude $500,000 of gain. That would leave you with just a $100,000 long-term capital gain. Now, there's a worksheet in IRS publication 523 called Selling Your Home that you can use to figure your own home's basis and any gain that you can exclude. If you can exclude all of your home's gain, which is quite common, because the exclusion is so large, especially for married couples, in that case, you don't have to report it on your tax return because the entire transaction would be tax-free. But if you do have gain that exceeds the exclusion, you do have to claim it. You do have to report the sale or the exchange of your property on Form 1040 Schedule D called Capital Gains and Losses and on Form 8949 called Sales and Other Dispositions of Capital Assets. As I mentioned, if you sell other properties that are not your main home, you must pay capital gains on all your profits. And I'll put links to these resources in the notes for the show. Note that there are exceptions where you qualify for the gains tax exclusion, even if you sell your home before living in it for 2 of the previous 5 years, such as when you're serving in the military or foreign service, when you're a government official or employee of the intelligence community, if you're volunteering for the Peace Corps, if your home gets destroyed or condemned, you're getting separated or divorced, or you experience the death of a spouse. In addition, you may qualify for a partial gain exclusion if you sell your home before living in it for 2 years due to a change in your health, workplace location, or having various unforeseeable events that are described in IRS Publication 523. So this list isn't complete. There may be other situations when you're eligible or ineligible for the home sale capital gains tax exclusion. So speak with a certified public accountant about paying taxes after selling your home. If you have any uncertainties, definitely get clarity because, it's a large purchase and you want to make sure that you're paying as little tax as, is legally appropriate for your situation. With some planning, correctly timing your sale, and qualifying for the gains exclusion, this could be one of the biggest tax breaks you ever get. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we've got a great team that works on the show. Steve Rickyberg audio engineers the podcast. Brandon Gatius is our director of podcast. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. And Nathaniel Hoops is our marketing contractor.